Hello everyone, my name is Jack Chapple. I upload business, entrepreneurship, investing, and finance videos pretty much every single day. And today we're talking about the best and worst ways to invest in the stock market, specifically in my opinion and the experience that I've seen and from reading from billionaire investors and from being around very successful entrepreneurs and investors. These are the best and worst ways that you can invest in the stock market. Now, I've invested a lot of money in the stock market for the past 5 years or so. And so I'm just going to be sharing the best and worst ways that you can get into the market. Now, anyways, let's get started here. We're going to start off with very first thing. So this is a bad one. This is one of the worst things you can do. And this is what I call, that messed up. So this is what I call loser funds. Loser funds. What are loser funds? What do you guys think are loser funds? These are for employees. These are for 80% of the population that 80% of the population is an employee. 80 to 90% is an employee. And about half of them invest in loser funds. What are loser funds? So these are things like 401ks and high fee mutual funds. Now people don't think about that. Like 401k, that's supposed to be just, my employer matches it sometimes. It's supposed to be just a long-term investment program. It is, but they invest in stocks and they take a lot of your money. And same with active mutual funds. A lot of employers or companies do this too. It's all the same thing, right? You're giving your money to investment companies that take to get this, to 5.7% of whatever you deposit into your investment fund. All right. Now, this is accounting for all fees because some companies do a deposit fee, withdrawal fees, active management fees, transaction fees, communication fees, legal fees. They put that all into these deposits here in the loser funds. And it's actually, I didn't even realize this. I was reading an article. It was like New York Times and New York Post. And there was one giant 401k company or mutual fund company, and their fees added up to 5.7% per year. Per year. That is robbing people. Because think about this, 5.7%, I mean, the market only goes up 6, 7, 8% per year. And so the people that are investing in this, they're only getting a couple % return. That's absolutely ridiculous. So that's the worst way you can invest in the stock market. Actually, there's another terrible way on here, but we're going to get to that. But you can make money from that in the short term in one of the ways I'm going to show you. But you're just essentially putting your money in a high interest savings account if you do that. And someone else is just taking your money. In fact, I was reading this, it was Tony Robbins' book, and they were saying that the average 401k or actively managed mutual fund, someone who puts money into those things for over the course of 3 decades, I think it was 30 years, on average, the company takes $185,000 out of your savings. $185,000 in fees, and that's not even accounting for the compound interest you could have got if you invested that yourself. Amazing, right? So think about that. The loser funds. Are you guys invested in those? Are you? A lot of you probably are. And I guess investing in this is better than blowing it on like purses and stuff. But this is barely investing. It's barely investing. So I'd recommend don't go into these. Invest on your own. So I think that's what we're going to move on to next here. So if you want to invest on your own and you don't have a lot of time, we're going to talk about the winners index. The winners index. So I talk about this a lot in my stock market program. You can check that out in the link below. And so the winners index is, if you don't want to actively invest and be trading all the time, which is what I recommend, it's a good thing to invest in low-cost index ETF funds, exchange-traded funds. So what I like to do sometimes, I don't do this with all my money, so I do like to invest in blue chip stocks. We'll get to that later. But I like to put my money into index funds, so funds that are exposed to like the S&P 500. So 500 are the top companies in the world. And I like to invest in funds that have a value proportional to that and pay a dividend proportional to those companies. So and those management fees are much lower. So you're exposed to 500 companies, 500 top companies. yet the management fee is 0.5% instead of 5 or 3 or 2. And in the long run, those percentage points add up over time. That can save you hundreds of thousands of dollars over time. So this is a good way. So this is the bad way to invest in funds. This is the good way to invest in funds. ETFs, the winners index. So invest in ETFs that track the market as a whole, and you will be just fine. You won't even have to look at your stocks. You just buy and then buy more. Even if there's a recession, just buy more stocks during then. Don't sell. Never sell. All right, we're going to move on here. So, yeah, so you have lots of exposure. So we're going to move on to number 3, I guess. Number 3 is the speculation game. Speculation game. So this is essentially those people that watch Mad Money, and a lot of stock people on YouTube. They give out specific stock tips about companies that they think are going to take off. At the end of the day, you have no control over it. You're having a guessing game. You're gambling with your money if you do this. So what's speculation? So it's the high risk, high reward way to invest in stocks. So it's stocks that don't pay a dividend, stocks that don't pay you to own them, and you're just hoping, you're crossing your fingers that they're going to go up in value. That's not a good way to invest, for the most part. A lot of people make money, but more people lose money that way. So I always recommend, I know I always get hate for this, but for 90% of people, for 95% of people that invest in the stock market, don't play this game. Don't just hope that a stock will go up. Have some sort of guarantee in terms of a dividend that a stock, that you can get paid back, that you can get some sort of return even if the stock goes down. All right? So what stocks should you stay away from here? I always talk about this: tech, commodities, etc. However, I'm not saying don't be in the speculation space at all. If you're a beginner, stay away from this. But if you're an intermediate to expert level, like I would say myself and a lot of investors that have been investing for years and years and years, I usually put like 10 to 20% of my portfolio into at least some sort of speculation stock that usually pays a dividend still, but it's very small. So like my speculation stocks, I remember Apple. Apple was a big speculation stock for me. They paid at the time like a 1.7% dividend when I invested in them. They were a speculation stock. And same with, like I've talked about, like Tech Systems, they were a big speculation stock for me. And so I'm not saying don't invest in speculation at all, because they can have very high returns like it did for me. However, I would say for most of your portfolio, stick to just safe stuff. And so that's where we're going to move on to number 4 here. Number 4, we're going to move on to the value game. So this is interesting. The value game is really interesting because it has been a good way to invest for so many decades until now. All right, now this is the Warren Buffett strategy, the value game. And so what do I mean by this? So the Warren Buffett strategy is you go through, I don't know how many stocks are listed now. I think that there's 100,000 across the world right now, public companies. Maybe not 100, maybe it's like 40,000 or so. But pretty much what Warren Buffett does is he goes into companies that have fallen out of favor in the public eye, but are still very valuable companies, or companies that are very undervalued. So what he'll do is he'll go through all their financial statements. Hey, this company doesn't have any debt, makes giant profits, yet their stock price isn't that high. That's the companies that he likes to buy. And so a good company would have been like United Airlines, or what was that company where they punched the guy, where they got the guy off the plane or dragged him off the plane and the stock went down like 5% and then it jumped right back up the next day. So stuff like that, where a company falls out of favor with the public, right? That's what Warren Buffett does. Now, however, so a lot of these companies that Warren Buffett likes to invest in have giant profits, right? And he likes to find companies that will probably produce more profits after he invests in them. But this doesn't work anymore. It doesn't work as much anymore. Why? Why is this? Well, since about 2000, you've seen that the PE ratio, the price to valuation, price to earnings ratio has gone through the roof, meaning that people are willing to pay a lot more money for a lot less earnings. And some of the biggest companies in the world do not turn profits, yet are some of the most valued companies in the world. Does anyone know what they are? I've talked about a couple of them. I guess I'll add a few here, actually. So some of them are Amazon. Amazon never turned a profit. Tesla, I think they've barely turned a profit, ever. And Snapchat hasn't turned a profit yet. And yet they're all giant companies. Amazon's going to be the most valuable company in the world pretty soon. Amazon. And never made any money once. So Tesla, same. Big company, never made any money. Snapchat, big company, never made any money. So that's why the value game is a little bit hard sometimes. Since the tech boom, the .com crisis and all that, since people started betting on future valuations of companies, it's been harder to play the value game because people don't care as much about profits anymore, which is, I mean, this is a whole other story that I actually had a conversation about this with my dad, was that like these days, like back when he started investing in the 80s, he would invest in companies that he think would turn big profits every year. And that's what most people thought, because companies that turn big profits, they're the ones that do the best and have the most free money to grow in the future. And they will not go bankrupt. However, these days, it's companies that take out tons of debt. I mean, Tesla, tons of debt. Amazon, all that, they need debt to keep them going. And it's just so strange. We're in an economy right now where people, okay, you know, this is a Gary Vaynerchuk part here. So people start companies now to sell them. That's why people want to start companies. People want to start companies now that are worth $100 million, don't turn a profit, and then sell them to Google. That's so many people's business strategies right now, and it's sick. That's not how it's one of the reasons why the economy sucks. I mean, people will turn their companies to shits and then sell them, and then the company goes bankrupt right after they sell them. That's what happened to, didn't Yahoo do that? That's one of the reasons why Yahoo went down the drain. It's because they bought, AudioNet, and a company that had tons of debt from Mark Cuban, and it failed. Something like that. I don't know if that's the exact story or if that's relevant, but still. People, when you want to build a business, you got to cash flow it. Don't take out all this debt. We're seeing that in stocks right now. Companies are just taking out debt to put bandages on a sinking boat. And some of those boats, sure, they can get bandaged up where they can probably be fine in the future, like in Amazon. Because I think that Amazon will be the biggest company in the world someday. They're very close right now, aren't they? Third biggest right now? They're up there, third or fourth or fifth. But actually, no, because there's all those Chinese energy companies. It's like Walmart, and then all the Chinese energy companies and oil companies, and then it's, you know, number 10 and 15 are like Apple and Amazon and stuff. But anyways, we went on a tangent there. So the value game, that's getting tougher to play these days. The value game, because people don't care as much about profits anymore. It's tough to find value. So we're going to move on to number 5 here. Number 5 is the long game. This is the best strategy you can take for the average person. For the beginners, for 95% of people, for 90% of people, most people watching this, the long game. So long game is the Kevin O'Leary strategy. You know what, if I say this, if I had to give my money to one person on this planet to manage, it'd be Kevin O'Leary. He's a dick, I know, he's a dick, but you know what, he has a good investment strategy and doesn't lose money. And so what's his strategy? This is how it should be for most people. It should be invest in companies that only pay dividends for the most part, that pay you a guaranteed well, he likes to go higher, but 2 to 6% dividend every single year. His lower limit is about 4%, 3 to 4%. But only invest in companies that pay a dividend and that are safe, relatively safe. I mean, sure, you can invest in mining companies and whatever, oil companies and all that, you know, companies that can tank for a few years and never recover sometimes. However, they still pay you a dividend. So you still get some sort of return from them. One of my favorite parts of investing when I was a teenager was getting those dividend checks. Sure, they were only, if I would get them every quarter, they'd be, for some companies, it'd be $10 or $20, but still, that adds up. You invest in enough companies, you invest enough money. I mean, it's cool, even though it wasn't a lot of money to me as a teenager, because I was making, $30 an hour on a corporate job. It's still a cool feeling, getting paid to just own something and not having to do any work in it. So That's what most people watching this should get into. And don't listen to stupid speculation like, oh, I'm feeling that this tech stock is really hot right now. You know, you know what we should close this out on? We should close this out on Bitcoin. And reinvesting. So actually, we'll talk about reinvesting first. So reinvesting, what I like about dividends is that it makes it really simple to reinvest your money. I mean, if you get 30 bucks in cash and 30 bucks here, 20 bucks there, 50 bucks there, 100 bucks, after you do that for a quarter, 2 quarters, 3 quarters, 1 year, you can reinvest all that money back into the companies and get a bigger dividend next year. So that's why I like the long game here, the dividend game. You get to reinvest your money. That's a great way to invest money. And so I think that we're going to close it out on Bitcoin here. Just I want to mention this because it was on Twitter. Someone sent me something about Bitcoin, and they had a big misconception about investing. So they saw the article. You guys probably saw the article about Bitcoin where they it was like someone who invested $100 in Bitcoin has it or is worth $72 million right now. That $100 turned into $72 million because they invested that $100 in 2009 or 2010. Bitcoin started in essentially late 2008. So they were an early investor. And so this person sent me the article saying, like, why don't we all just invest in Bitcoin because we'll all be guaranteed to become millionaires in 7 years. And that's a big misconception about investing. That's speculation. So my opinion on Bitcoin, just to kind of get this out there, out of all the speculatory investments that I would make, that might be number one. If I were to do that, now I'm investing in stuff I like control over, so I'm not going to do that. However, I do like Bitcoin right now. If you want my honest opinion on it, do I think you should invest it? I would say look into it on your own, see if it's right for you. I would if I wasn't running my businesses right now. If I was an employee, I would be investing in Bitcoin, but I'm not right now. So you look into it for your own situation. However, so this person was saying how like Bitcoin is showing a 600% return last year and had whatever 10,000% return 3 years ago and 100,000% return 7 years ago, right? And so they thought that if they invested $100 today, that it would make them multimillionaires in 7 years. And everyone knows that's not how that works. I mean, you know, investing $100 in Apple in 1978, that would be worth millions of dollars today. However, if you were to invest $100 in Apple today, that might make you 4%. So a lot of the growth for stuff like Bitcoin and those speculation investments, they've already happened. You've missed out on a lot of the growth. However, they can keep growing. I mean, Bitcoin is still, I don't know how much money's been put into it, maybe $1 billion, probably a lot more than that, 10 billion, 100 billion. But what I'm trying to say here is that to that person who thought that they would get a multi-million-dollar return, and anyone who invests in a speculatory investment that has had good returns over the past 7 years, that they think that it'll continue for the next 7 years, that's unlikely. And I want to get my opinion out to everyone there that just because, you know, some stock has done well in the past, growing at 10,000%, it doesn't mean at all that, I mean, there's companies that have made Bitcoin illegal in the past 7 years. There's about 5 or 10 countries that have made it illegal. And Bitcoin's had hundreds of millions of dollars stolen from them, from people's like personal accounts. So, I mean, that's my opinion. It's risky, but it might be worth it. So, I just wanted to get that out there. That's a speculation investment, which I would have potentially jumped into. You look into it yourself. It could be good for you. It could be bad for you. I don't really know. So that's going to wrap this video up. Make sure you check out my stock market program in the link below if you want to know more. If you're a beginner, just starting out, if you're a young person, that program is just for you. It's $57, and it'll take you from not knowing anything about stocks to making an actual trade and setting up your account and all that stuff. So that's going to wrap this video up. I'd like to thank you very much for watching. You're all very beautiful people, and I'll see you guys in the next video.